Yo, what's going on, guys? So I've already made an FVG video before, but I wanted to make another one. A lot of newer members are wanting to learn about them and maybe utilize them, so I wanted to make a refreshed model. Um, just gonna go over how I get a daily bias using fair value gaps and simple swing highs and swing lows. No EMAs, no SMAs, nothing bad about anybody that does use them. Everyone has their way, but this is my way of doing it. My way of feeding my family, and I just wanted to come out and share that with you guys. So, um, basically, a fair value gap. What is a fair value gap? So, a fair value gap is going to be like this. It's when it's a series of three candles, right? You have this candle right here, you have this candle right here, and you have this candle right here. Your fair value gap is the gap between the first candle's low or high, depending if it's a bullish or a bearish one, and the third candle's high. In this case, this is a bearish FVG. So depending on where price is, see we've already taken all these lows and whatnot. So this tells us if 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 price wants to continue higher. So let's start off with a fair value gap is basically showing displacement one way or the other. Price was moving so fast that it's showing displacement, it's showing speed in going one direction is the best way to explain it. Another way to explain it is it's basically like when you paint on a wall, how you like roll the brush up and you slowly like lose paint on the wall and you have to go back down and fill it in. So basically, you have orders that were in here that did not get filled. So the market likes to go back and refill those FVGs where those orders did not get filled. Like price, it's showing us displacement where price is moving so fast that it's showing us where price wants to go. Like you get this much, speed of displacement, especially on like an hourly or a 4-hour candle. It's showing you price wants to go up higher. You have, if you this so this would be a good example of a bullish fair value gap. So we can use these as when we're in this is like a buy model here, and then you have your sell model here. You like if you go back and look, like you have buy model, sell model. Like you have these curves all the way. You have sell model here, and then a buy model back up to take the high from where the sell model started, and then you have you know buy model and sell models where you end up taking the low. It's just you look back on the charts, and those buy and sell models are everywhere. So what we are looking for is a lot of people can trade them like there's a lot of times like you see we'll come back, we'll fill in an FEG, and then we'll and then we'll go back higher. I tend to use them more for for inverses. So a lot of people like there's different ways to utilize them, but like what I was getting to like in a sell model, you would expect. So this is a bearish fair value gap. Why? You have a gap between the third candle's low, the first candle's low, and the third candle's high. So you come back up here, you test it, you come back down, you test it one more time, you price never gets above it, you continue down. So what you can expect, these sometimes you might get a slight close above, and then price continues to reject. But you notice here, this is a different situation. We do close above, but then you see we have an hourly order block here that sends price back down. So what I use to I so my way of looking at it and seeing where price wants to draw to, right, which is our draw on liquidity, where the higher time frame is looking to go and seek liquidity, right? Where are the most orders sitting that where the algorithm can get all that money from those stop orders and those limit orders into the market. So um, if we have if we have an FEG and we end up inversing it, so basically this is a bullish FVG, right? So obviously we come down, we take some highs here. We come back down. You see, we close below it. Some people would buy this. There's different instances where you would buy it. Obviously, we took all these highs. You you would not just randomly buy this hourly FVG, right? So the fact of so we're made up of a buy model here and then a sell model. Sell model, we should expect price to come back down and take these lows. So once we come down, you see there's no other, we have like a small hourly FVG in here and whatnot, but like there's nothing supporting price on this side. So when we come back down, we close below this hourly fair value gap. If price was going to bounce, it would have been at this fair value gap. So closing below this shows us price wants to go lower and seek the last lows, and then complete the sell model is probably the best way to put it. So you look at these lows, boom, we come down, we seek that level, and then we push back higher, and then we start a new buy model complete, sell model complete, all from this hourly inverse, right? You can use this on any time frame down to the 5-10 second if you want, but because like you obviously have like hourly buy models, sell models. You have 1 minute buy model, sell models that happen within these hourly candles all throughout the day for anybody that's scalping. But like on a higher time frame, you see you see inverse. Sometimes we come back up, we retest that inverse like we do here, but we should be aiming for at least the next low, like probably at least this low. Maybe this volume imbalance would be a good target. You can scale at any of these spots here, but if you want to me go for that higher risk reward, you go for the last swing low. You see we take it out by just enough to stop out anybody that went long here or in here. They're where are those people taught to put their stop loss? The last swing low. So the markets in the algorithm is going to attack that level, stop them out, and then take it back the other way. So looking at other models, you see like, okay, we're going back up. We can probably expect, like if we see this kind of displacement, you see we got this hourly FVG. You see we don't reject it. We kind of reject it here, and then we push back up. We kind of respect this candle's wick, order block, and whatnot. Um, maybe there's like a 5 or 15 minute here, but I'm just trying to stick to the hourly time frame to kind of show you how I get my bias, looking like on the day, like on the daily, because obviously there's what 6-7 hours in a trading day, so if we're inversing this hourly FEG or this hourly FEG, you have time with these hourly candles to at least go attack this next hourly FEG. So if we're watching this on the hourly chart, we see this candle close over this hourly FVG. Tells us we're not going to reject here, right? So where would we expect next? We would at least expect to go up here and tap into this into this hourly FVG, right? So it's the next point of interest that the market could possibly be drawing to. So you see, maybe you long here, you sell at this one in case we do reject it. In this case, we do not. You see, we end up closing over it. And then once we close over this, where else can the market go? Where else would it be going? Oh, this last swing high, taking out that high. And then where does the market go? Back lower. But you notice sometimes we do not always deliver right to it. You'll notice this is a case of, oh, we come back down. You see, there is no hourly FEG here. Why? Because this wick goes and touches, this candle. So there is no gap here, but there is a gap here. The market likes to fill these hourly FEGs in. You notice there's nothing here. There might be a small, tiny one here, and then we eventually come back and fill that eventually, right? But you see, this is how they can, people call it games, call it whatever you want, but you see sometimes the market doesn't deliver. That's why you always got to be careful. And then we come back down, hit an hourly FEG, and then we eventually go back up, take out our original target here, and then we go back lower. So like moving on, so like whenever I'm looking at this on like a daily or I love the 4 hour and the I love the 4 hour and the hourly time frame for this. Can even use the obviously use the daily time frame. But so like yes, so like we'll say, but going back to September here. So if we came in, let's see, this candle, this was the 10 o'clock 4 hour candle. So when I'm looking at this, I wake up in the morning and I see this. I imagine all of this is not here, right? I'm looking at this 4 hour candle. and I'm like, okay, this is gonna be my bias here. Like, obviously it's a 4-hour candle. These candles don't happen until the next day, so maybe imagine this is like an hourly candle, right? I'm coming in and I'm like, okay, my bias is gonna be bullish if we close over it. We end up we do. Obviously, this is next day. Remember, it's an hour. Remember, for example, we're just looking at an hourly candle here, but you see we close over, we come down, we retest it, and then we end up push higher. Where do we go? This swing high. So like as soon as we close over this, I'm expecting at least this last high right here to be taken, and then possibly this one. You see, we take it, and then what happens? Market reverses, goes back to the last swing low, and then and then we end up taking these ones out, and then the market goes down, takes out more lows, and then you go all the way down here, and then market finds like an area. Maybe we had like an SMT with ES where ES didn't did take a, or where ES did take a low. But look at this. What happens here? We have a 4-hour FVG from way back when. Market taps into it. Guess what? We push back higher, and then we know, oh, on our way back up. Look at that. We get a close over. In the process of closing over this one, we close over this one. So we should guess or know that price wants to attack at least this last high. And look at that. So it's just this is how you can take like This is like most of the time whenever I'm giving alerts and whatnot through the day, it is on the 3 or 5 minute time frame. But I'm just using you. This is like just using this for a higher time frame thing and how I get a daily bias. But you see, like it's real simple. You just need these fair value gaps, swing lows, swing highs, and you can form a daily bias just simply off of that. So like maybe coming into this day, I said, oh, if we close over this 4 hour right here, I'm gonna be bullish, right? Where am I gonna be bullish to? Back to this high. So that's how you end up. You can end up with like with your FVGs telling you where price wants to deliver to. So and then we'll go down to like the 5 minute chart. So I'll show you an example here. So this was from uh, yesterday, Tuesday, CPI day, right? We have a higher time frame target here. These were CPI highs, right? What do you notice? Do you see any fair value gaps in here that we can use? Nope. Nope. Okay. Well, look, there's one right here. There's a 5 minute FVG right here, right? We know price is going to come up here. Is it going to reject it or is it going to close above it? So we look here. Obviously, we know this high should get taken, right? If we close over it, we close over it. We close way above it. So it didn't give us the best entry, right? But we know there's still data highs up here. So close above it. Our target is data highs because we know data highs and data lows are strong points of liquidity where the market likes to draw to. And what do you notice? Boom. We go up and we take data highs and then we continue our higher push. What's also uh, see if I can find it here. 16764. See if I can find it here. So it's probably not going to show up, but what do you notice here? This 5 minute FVG shows up after we are already bouncing from a 4 hour FVG. So this 5 minute FVG that we're looking from, look, this is your 4 hour FVG. This is your 5 minute. So this 4 hour is holding price. It's strong enough. It sends us through this 5 minute. It tells us this 5 minute should be a good inverse. This is like your confirmation long. Like, okay, we bounce here. This is your double confirmation that price wants to go higher because we bounce from here. Oh, and it goes up. It inverses. It has no respect for this 5 minute FVG to reverse price. We should go up to a data highs now, right? So that's how you kind of use them there. And then obviously you kind of see like price got a little bit sloppy here We had a 5 minute FVG. You see how we tapped into how we tapped into it, came back down. We inversed it. We took out some of these lows. But you notice anytime we inverse it, we usually come down and take some kind of low, and then we end up in and then we end up going back up. So if you missed that entry, there was this entry, or there was this entry right here, where eventually we closed over it. Boom, boom, boom. Come back down, or like even if you entered here and you waited for this one to close above, boom, you could have waited for the retest of it. Price supports it, boom, data highs. So I mean, there's plenty. You see, there's 1, 2, 3 entries you could have. There was some 3 minute, some 1 minute entries as well. But that's how you kind of use like inverse FVGs to kind of show you like price is always going to draw back to those FVGs. The best way to put it is price is always going to draw back to those FVGs. And if price does not respect those FVGs, then that's telling you price wants to go in that and continue in that direction, right? Otherwise, price would have respected them. So if we go to our current 4 hour chart, let's see if YMQ likes to do this here. So you look at our current 4 hour chart. What do you notice? FVG. You notice we have a 4 hour inverse here. There's a small gap here, right? Low, high, not touching. This is a 4 hour. We close over it. We close over it, retest it, go up. We take this high. Look at this. We come back down. We hit 50%. We hit 50%. We hit this lowest 4 hour FVG. Price continues higher. What do you see next? Another 4 hour FVG, right? So boom, boom. This price holds. We should expect this last high to be taken. We see we take these highs. We push back higher. Oh, we come back down. For this 4 hour is supporting price. So I'm just showing you guys the difference between like an inverse or a regular FVG. But this is how like okay, this is how I've got my bias for the last couple of days. I come in, I'm like, okay, as long as this 4 hour FVG holds, I am continuing to be bullish. And then the same thing, this happened today. I came in today and I was like, as long as this 4 hour FVG holds, I'm bullish, right? And look at that. So that's how you can just use them. If we end up coming back down and we close, we come down tomorrow, we close below this, we should expect what? This low to be our next target on the NQ chart. So that's pretty much how I use FVGs. Already 18 minutes into this video. Just want to show you how I kind of use them. I hope you guys appreciated it. One more thing I wanted to point out. Obviously with this low here, we did not, this low right here, we did not take a low, right? You're like, oh, what happened? Well, if you go to the ES chart, this is why, again, why it's important to watch both charts. If you go to the ES chart and go to the 4 hour chart, this low that NQ took was up here. ES took these lows. So if you go back to the NQ chart and look at it, this is why. So as long as ES or NQ take the lows, you can then reverse. You do not need both of them to take the lows to reverse. That's why it's just important to watch both of them, especially if you are in like a long position. So maybe see how this one did not. It took this high, but it didn't take this high. Maybe ES did. You would have. That's why it's just important to watch both. Just wanted to point that out. But I hope you guys enjoyed the video. I do love making these for you guys and helping you guys learn. If you have any questions, remember my DMs are always open. Love to help. Hope you guys have a fantastic evening. Learn something from this, and we'll see you guys later.